two major types. There are more than two, but uh, for our purposes, I'm going to consider only two. One is straight line. Equipment is depreciated to zero over the tax life of the equipment in equal amounts. So you buy an equipment for $10 million, and IRS determines that it has a tax life of 10 years. That means over the next 10 years, you're going to write off $100,000 in depreciation cost. You just divide the costs. So annual depreciation would be cost of equipment divided by tax life. That's it. This is relatively rare, but what's most used is modified accelerated cost recovery system, known as MAKERS, affectionately. There are tables of these. I think I already have one. Let me see. I must have done this last year, so let's find out. Because I don't want to do it from scratch. Maybe somewhere around here. Let's do this. All right. Let me move this to a new book. For IRS purposes, there are, let me see, 1, 2, 3, 4, 5, 6 different tax lives depending on the equipment. The 3-year, 5, 7. Under MAKERS, the 3-year assets are actually depreciated to zero over 4 years. Go figure, it's IRS. But if it was, and the first year is always equal to the amount you would have charged off for the straight line. But the second year is higher. So for a 3-year MAKERS, the first 2 years you would have written off about 78%. Under straight line, you would have written off about 67%. For a 5-year, the first 2 years you would have written off 52. Straight line, you would have written off 40. You just write it off faster. You know, if you're paying interest for borrowing, that means it's beneficial for you. We have those tables, okay? Now let me also get the salvage value template there. Okay. In this case, this handles up to year 21. Let me see. I'm going to go through the formulas a little bit. Or, I mean, in this case, it's input. This input is coming from somewhere for now. $3 million. Tax life is 10 years. That's the tax. Okay. 10, 22. This one asks whether it's using makers or not. If it's yes, it basically says 10 years. If it's no, it's going to determine what these depreciations are going to be based on that. Pre-tax salvage value. At the end of the project, I figure I can sell this at 200,000. Okay, and salvage year, tax life of the equipment versus the life of the project are two different things. Okay, suppose the project has a 7-year life or 5-year life. At the end of year 5, I'm going to sell the equipment at the salvage value, and I need to determine how much taxes that are due. Salvage taxes are pre-tax salvage value minus book value at salvage time. Book value of an asset is equal to historical cost less accumulated depreciation. Okay? That's important because as far as IRS is concerned, if, let's say I'm selling this at 200,000, and let's find out what the book value was at the end of year 7, 900,000. Okay. As far as IRS is concerned, I sold something that's worth 900,000 at 200,000, so I lost money. That means, for corporate taxation purposes, that's going to bring tax credit. That reduces my taxable income. If this was 1.2, why am I getting? Oh, year 5, I'm sorry. Let's make that year 7. Okay. At year 7, I sold something that's worth 900,000 as far as the IRS is concerned. Because I'm telling IRS every year I spent $300,000 on it. I didn't, it's depreciation, but IRS says, okay, you can use that to reduce your rent, disposable income, taxable income. But by the end of year 7, I have written off everything except that 900. So IRS says you already declared others as expenses. Just because you lost money compared to your acquisition costs, that doesn't concern me. You have already written off at that point $2.1 million. So I'm going to treat this as sell off of an asset that is worth 900. If you sold it at 1.2, you made 300, I'm going to tax you on it. If I sold it at 700, well, I lost money. Hence, my taxes are going to be reduced by 44,000. All right. And the way this works, these rates are coming from a lookup. I'm going to make sure that it doesn't depend upon that other worksheet, which is open right now. But if I say this is makers, as you can see, it pulls up the appropriate depreciation rates. Book value at the end of year 0 is obviously initial cost. Then every year, I'm going to reduce the depreciation for that year from the book value in the previous year. And this little VLOOKUP function, it actually tells me, I can, of course, eyeball what the number is, but, Excel functions are better than eyeball functions. And if I simply change that to 5, I don't have to worry about it. I can immediately calculate the taxes, and after-tax salvage is simply pre-tax salvage minus any taxes. Remember, if the taxes are negative, that doesn't mean pre-tax salvage and after-tax salvage are the same. Negative number is positive. Let me save this as okay. These little depreciation numbers are going to be useful for us too when we put the project together, because if the project has, let's say, 7 years, 5-year life, we're going to need those depreciations to calculate net income. But for the salvage value purposes, we've already calculated them. All we have to do is grab them from there. Okay? I'll stop here because I'm going to do all the other stuff within the context of a large project. I want that to be self-contained. As I said, I posted the Chapter 8 quiz. I forgot to post Chapter 7 homework last week. So tomorrow morning, I'll post both 7 and 8, and I'll give you basically 2 weeks to do it. You'll have more than enough time. And remember, all the other quizzes are still open, and they're due Wednesday midnight. But if you need more time, let me know.